I'm Taylor Riggs in San Francisco. This is Bloomberg Technology. Coming up in the next hour, lowering expectations. SoftBank puts together a rescue plan for WeWork that may value the co-working company below $8 billion. That is a far cry from the $47 billion valuation it had in January. Plus, remembering a tech giant, Oracle CEO Mark Hurd dies. More on his life and storied legacy at Oracle. And making the rounds a day after telling Georgetown University students and faculty he won't police political speech, Facebook CEO Mark Zuckerberg talks to television outlets. We hear what he had to say Friday. But first, our top story. WeWork's valuation may be sinking lower. Bloomberg has learned that SoftBank is putting together a rescue financing plan for WeWork. It may value the office-sharing company below $8 billion, and that is a fraction of the $47 billion valuation that the startup commanded as recently as January. Since it scrapped its initial public offering, WeWork has been considering dueling plans from SoftBank and JP Chase. Joining me to discuss, it's Andrea Walne, partner at Manhattan Ventures, and also with me, Bloomberg Technology's Sarah McBride, who has been tireless and endless on all things SoftBank. So what did we learn today about this new valuation?
Well, it's even lower than expected, around $8 billion. And as you just said, that compares to around $47 billion at the start of the year. So a huge drop there in under 12 months.
And Andrea, if you take a look at $8 billion, are we getting closer to fair value?
I think we are. Overall, something that I always like to consider, especially being in the late stage venture space, is what will carry over to the retail. And I feel as though with an $8 billion valuation, it does show that WeWork has a real business. But I think there's still time to be able to tell what actually ends up happening here.
And is an $8 billion valuation something that retail might be looking at if there ever were to be an IPO?
I think so, right? Because with WeWork, we see that we do have a perfect comp in the form of Regus. So in that sense, WeWork is a strong player, but there's a lot of cleanup that has to be done, operationally, management, and otherwise. But I think it gets a lot closer to fair value.
So Sarah, with this deal by SoftBank, what do we know about the terms? Does SoftBank want control or do they not?
Well, everything is still in flux, but part of what's under discussion is preferred shares with non-voting rights. So basically at this point, anything is possible. They still only have 2 board seats. So things could go in any direction right now.
And you've been nodding your head. So what do you make of that? Majority owned shares, and owning seats on the board. As you take a look at WeWork and some of the other companies that you analyze, how important is that in terms of getting this company to the finish line?
I think that SoftBank knows where they stand in this equation. I think that they know where they can come in to help save the business, quote unquote. However, I don't think that they are a type of firm that is going to step up and say, we have the abundance of experience to take this business to the next level. So I think with SoftBank's power, they're going to look to identify the right leadership team.
There was also a dueling offer,
yeah,
Sarah.
Right.
So talk to me about that.
So JP Chase is putting together a group of potential debt investors in SoftBank. They're still shopping that around among potential investors. And the advantage for WeWork in a debt deal is they wouldn't have to give up as much control. It wouldn't be dilutive. And SoftBank's terms would be. The thing with the JP Chase package is it would just take so much longer to pull together, whereas SoftBank could come up with this money very quickly. So that's the advantage there.
And I want to take a look at a chart here that I'm showing to our Bloomberg terminal audience, which we know the story. It's the bonds that are trading down to about 84 cents on the dollar. Yet that is a far cry from a 30 or a 40 cents, which you typically see when you're looking at recoveries. Sarah, when you take a look at the JP Morgan deal and the bonds, 15% coupon, I know we don't know much about the yields or the price at which the bonds would come, but any sense that there is a general market appetite for something, a big high yield deal like that?
Yeah, I would say so. I mean, they have found potential investors. Nothing is firm yet, but just the notion of a possible deal sent WeWork's existing bonds up higher this week. They had been trading even lower. So there's always, if you price something right, you can always find a market for it.
What are your takes on the JP Morgan competing deal?
So I think overall, as we've seen in the real estate market, bondholders really do enjoy a strong real estate play. So what we have to keep in mind is that with bondholders, they're looking for steady income. So with WeWork's business, if they can turn it around, I think in a long-term strategy play, the bond would actually perform very well. But that's taking the bullish perspective. There's a lot that has to happen between now and that turnaround.
And Sarah had mentioned that the JP Morgan deal would take longer and that one of the big benefits about SoftBank is you can get it done quickly. How soon do we know that this company needs cash? And if they get it, how long does that last them?
Right. Well, if they can minimize a lot of the overhead affiliated with sales and marketing, which I think is really trailing on their balance sheet right now, the business could sustain a little bit longer than we were all expecting. However, they do need about $3 billion in cash going into Q1 of next year.
Sarah, as we take a look at the SoftBank side, how much of their reputation is at stake here?
Well, the thing is that people wonder how much this will affect the Vision Fund, but people forget that of the more than $10 billion that SoftBank has invested in WeWork, only about $4 billion comes from the Vision Fund. So some people exaggerate the effect that it would have on the Vision Fund, but overall, SoftBank has invested $10 billion. That's a lot of cash going into a company that seemingly careened out of control. So I think it's appropriate that they're stepping up with a plan for how to try to turn things around. And they've got a slate of executives that they think might be able to help run the company. And you know, it's a difficult situation for them now, but they still potentially could turn things around.
And what is the significance that it's SoftBank and not the Vision Fund that's stepping in here?
Well, with that information, it allows us, the Vision Fund, to really prepare for their second fundraise that they're ramping up for, right? So I think the plans for that were a little premature. They wanted to see the returns on that portfolio, but with SoftBank as the organization stepping forward, it alleviates some of that burden and some of that stress on the Vision Fund in particular.
And Sarah, we were also getting news that the creative chief of WeWork, Adam Kimmel, is said to be resigned. Generally, at what point does it become hard for this company to retain talent if everyone keeps leaving?
Well, it's going to be very difficult for them to retain talent, but at the same time, that offers an opportunity for them to reinvent themselves a little bit, bring in a new team, say we're coming at this fresh, and here's our plan for turning things around. So they can turn that to an advantage as well.
I think this is the story that keeps on giving. Thank you both. That was Andrea Walney of Manhattan Ventures partner and Bloomberg Technologies, Sarah McBride. Thanks you both for joining me.
Thanks.
Now I want to go over to Mark Hurd. He was the chief executive officer of 3 major technology companies, including Oracle, and he has passed away. Oracle announced last month that Hurd was taking a leave of absence for unspecified health-related reasons. Chairman Larry Ellison said Hurd was, quote, a close and irreplaceable friend and a brilliant and beloved leader. Mark Hurd was 62. For more, I want to bring in Bloomberg Technology senior executive editor Brad Stone to talk about Hurd's legacy. So Brad, what is Hurd going to be remembered for?
Well, Taylor, Mark Hurd, has really been just an extremely visible, productive CEO in Silicon Valley, really, for as long as I can remember, but particularly starting in 2005 at Hewlett-Packard, where he expanded the company through acquisitions. He made it a lot smaller through layoffs and relentless cost cutting, and a tenure that was marked by some controversy. If you remember the pretexting scandal where they were trying to identify the source of leaks, and then he left under a kind of haze of controversy around expense account improprieties. And now more recently as the co-CEO of Oracle, and I think to answer your question, the legacy is really one in helping to steer Oracle from this kind of traditional business model of selling licensed software to a cloud-based company that now has to compete with the likes of Microsoft and Amazon.
And how important was Hurd to Oracle? Like you said, instrumental in taking the company from the legacy business into the newer cloud model. Are they set to be able to continue to do that in his absence?
Yeah, I think so, but he was important. One, he articulated the need to move to the cloud early. I mean, if you remember in the late 2000s, Larry Ellison was calling cloud computing a fad. And, you know, Mark came in and kind of put a stake in the ground, orchestrated the acquisition of NetSuite a couple years ago, and has really driven that transition. But he's also been the public face of Oracle, and that's where I think they're going to struggle to replace him, at least in the short term. Safra Catz, his co-CEO, really operates, in the background. Larry Ellison, the chairman and the visionary, you know, we only see him a couple of times a year now. Mark was the guy who was talking to customers, talking to us in the media. He was delivering the keynotes at Oracle World, and I think they're going to struggle to find a replacement there.
Talk to me more about what Oracle does from here. In that September earnings statement, they'd highlighted that they have a deep bench of leadership that is certainly qualified to take this company into the next stages. How prepared are they, given there is Safra Catz who's there, Larry Ellison is there? How prepared are they? And frankly, do we know anything more about Oracle's leadership team going forward?
Yeah, I'm probably not the best person to answer that. I know that Larry Ellison has talked about some of Hurd's deputies as potential replacements. You know, they do have a deep bench. They've got, you know, a recent record of success. They hit a stock high earlier this summer. The stock this year is up 20%. But look, I mean, there are some existential questions. You know, Amazon, now a competitor, made a big fuss last week when they announced that they had moved their entire retail business, the consumer business, from Oracle into their own database cloud services. So clearly, you know, they've got some now kind of vocal rivals that are creating some stir in the marketplace. And where Hurd was really so good was he could kind of give as good as he got. And now, you know, they need a sort of chief general on this battlefield that has become cloud computing.
Bloomberg Technology Senior Executive Editor Brad Stone, thank you for joining me. And we'll have more when we come back. Let's get a check on the top analyst tech calls. Starting with Microsoft, the price target was raised to 160 from 153 at RBC Capital Markets, which called the software company one of the most likely outperformers over a multi-year period. The analyst hailed the company as the king of cloud. Shares of Snap fell Friday, even after analysts at Bank of America upgraded the stock to a buy from neutral on stronger monetization trends. The analyst said he has higher conviction on realizing potential for Snap average revenue per users. The company reports quarterly results Tuesday. And shares of Tesla fell Friday after Piper Jaffray analysts lowered the price target to $372 from $386, saying it reflected a toning down of the optimism that was reflected in original near-term estimates. Ahead of quarterly results on Wednesday, the analyst expects a 2019 loss per share of $2.94. And those were your top tech calls. Now, and financials. The Chinese online finance giant, controlled by billionaire Jack Ma, expects credit demand among small and mid-sized enterprises to remain strong despite a decelerating economy. CEO Eric Jing sat down for an exclusive interview with Bloomberg's Tom McKenzie. He started by asking if deal-making is in the company's future as competition heats up. Take a listen.
I think our investment philosophy is very straightforward. We're only doing strategic investment. Strategic meaning that investment in that portfolio company is fully aligned with our overall strategy. I mean, can strengthen our strategy instead of can be drag our focus. That's not our. So we really focus on strategy investment. I mean, and number one. Secondly, we really focus on post-investment management. To really we have a strategy rationale to invest, and post investment can we really achieve the synergy by working very closely together.
One of your key partners obviously is Paytm,
Yeah.
the leading mobile payments provider in India. Are you looking at increasing your investment there? They're looking to raise maybe $2 billion.
I think Paytm is doing very well. I'm very happy be a partner of them. So I still remember back to about 5 years ago when I first looked at the company. I really like. Actually, I always told the founder of, which is Vijay, is the founder and CEO of the company. I told Vijay when the first time I'm looking at the company. Actually, I don't like the business of the company. I really like himself because he's so kind of very energetic, very passionate with a strong vision. Overall, I think India, the whole economy is also, developing very healthily and faster. So I think, Paytm is in a very good position to capitalize on that opportunity.
Let me ask you about your future plans for the business. When do you plan to IPO Ant Financial?
You know, we last year we just did a new round of financing. So the company is very healthy in terms of operating metrics, in terms of cash flows. So we're happy with the overall the business momentums. So we don't have a near plan for the other, for the capital raising, or we don't have any plan for IPO for now. But when we have the plan, I will let you know.
Would it be realistic to think that you would be ready to pull the trigger on an IPO in 2020?
We don't have the time. We don't have plan right now. When time comes, it comes. We'll let you know.
Okay.
But I think, and one thing to add is that, IPO definitely. IPO is not. It's the ultimate goal of the company. It's just one stage of the company.
That was Ant Financial CEO Eric Jing. Now, video game stocks traded lower on Friday. Wedbush cited new data showing monthly software sales for consoles and handheld devices fell 12% in the last year. Analyst Michael Pachter says the decline was partly due to the launch of Sony's Spider-Man a year ago. That was the fastest-selling first-party PlayStation title in history. And coming up, Mark Zuckerberg is still out there pushing back against Facebook's critics. This time, he took to Fox News to say there was no anti-conservative bias at the social network. We discuss next. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology. Be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg. Facebook CEO Mark Zuckerberg was again defending his social network, this time on Fox News on Friday. Much of that was the same set of talking points he offered at Georgetown the day before. He also continued to make the case for why Facebook is involved with political advertisements.
Should we be in political ads at all, right? Is that just something that we should block completely? And, from a business perspective, the controversy that all this creates is clearly not worth the very small amount of our business that is based on political ads. That's not really anywhere near a big part of what we do. But the reason why I've stood up for this, ads can be an important part of voice.
Joining me to discuss the man who literally wrote the book on Facebook, it is Techonomy's David Kirkpatrick in New York. David, give me your thoughts to what you heard there about Facebook being in or out of political ads.
Well, one of the things that Zuckerberg kept saying both in the Fox interview and in his speech at Georgetown yesterday was that in a democracy, the people should decide. In other words, the users of Facebook, the people, should decide what they think is true and not true, and that they should not be sort of treated condescendingly with the company deciding for them. But in reality, the way that people, citizens in a democracy, decide what they want is by voting for politicians who then set the laws. And the thing that I feel was most missing from Zuckerberg's talk and interview is the recognition that he has to work with government in order to figure out what the best way to handle these things is. He keeps saying, I've decided, I believe. It doesn't really matter. One man should not be making these decisions.
I thought it was interesting that he also said that they shouldn't even be in the political ad business. It's not a big portion of revenue. They don't need it for business reasons. So then why are they?
Well, he said they need to be because he believes that, it's empowering for the community to have politicians at all levels, from the local school board all the way to the president, having the ability to have a voice on Facebook. And I don't disagree with that. In fact, there are many points he makes about how empowering social media and Facebook in particular have been for ordinary people and politicians at all levels, small business, etc., that are really right. And it's true that ordinary citizens, everyone at all levels, has more of a voice today than ever before. But I don't think he's fully owning up to several things, but one of them is the degree to which the only way this can properly be resolved, even in an ongoing basis where it has to continually being refined, is if government is at the table along with the companies.
Well, and you know who else is at the table? It's China, and he talked a lot about China and sort of Facebook needing to be able to take on them, or else we will all lose out. I want you to react. Take a listen to what he had to say.
China is building its own internet focused on very different values, and it's now exporting their vision of the internet to other countries. Now, until recently, the internet in almost every country outside of China has been defined by American platforms with strong free expression values. But there's no guarantee that these values will win out.
David, is that a valid argument, or is he just speaking his book?
Well, it is a valid argument, and it's also very opportunistic for him to be making it. I mean, after all, Facebook came this close to launching in China a number of years ago. I think it was in 2011, when the Chinese government decided after Arab Spring they weren't going to allow it. And if Facebook had launched in China in partnership with a local player, which was what they were intending to do, they would have sacrificed a lot of their supposedly absolute values that he's now defending. So, he will do what is useful for his business. And I also think one of the things that he's leaving out of all of these discussions is the extraordinary profits that he's taking from the entire ecosystem in the midst of all these controversies. And, it's one of the reasons why so many people are so suspicious of him, and why his reputation is mud, both among informed citizens and also among politicians.
Quickly here, just about 20 seconds. He continues to say breaking up big tech doesn't solve the problem. Your thoughts?
I'm not a proponent of breakups per se. I'm not ruling it out as an idea, but I don't think that's the solution. I think, whether it's good or bad, government has to get more informed and figure out what to do about these platforms by engaging with them. Breaking them up is too easy.
Techonomies, David Kirkpatrick, you will be sticking with me. And coming up, we continue to talk Facebook in our look back at the week in tech, but we'll be looking at its plans to push forward with its cryptocurrency, Libra. That's next. This is Bloomberg. This is Bloomberg Technology. I'm Taylor Riggs in San Francisco. Now to our weekly roundup of the top tech stories in tech, starting with what else but WeWork. So as we told you earlier, the office co-sharing startup, once valued at $47 billion, now looks like it's closer to about $8 billion or less. And this comes as yet another executive has jumped ship. To discuss in New York, Techonomies, David Kirkpatrick, and Bloomberg Business Week's Max Chafkin. Max, let me start with you. $8 billion, closer to fair value?
The fair value is whatever they end up paying for it. I think the question that people should be asking themselves is why anyone was able to talk themselves into thinking it was worth $47 billion. Especially when you have a drop like this where not a whole lot changed. I mean, what's so crazy about this WeWork story to me is a lot of the things that investors have sort of freaked out about retroactively were things that were out in the open, things that were in the S1. It was all sort of there, and I think you have to wonder, was SoftBank kind of kidding itself, in an effort to, raise money for subsequent funds, for the Vision Fund 2, and was the rest of WeWork's kind of cap table just sort of going along for the ride?
David, do you think $8 billion is still too much?
It might be. I honestly think there's a real question whether WeWork will be a going concern in a year, or certainly 2 years. I mean, honestly, I know people who have offices in WeWorks, significant companies who are making contingency plans in case they come to work someday and find the door locked. That is how bad it could be. I don't really see this company having fundamentally good economics. If they don't raise this debt, they're in deep trouble.
Max, why does SoftBank appear to be throwing more money at what was already, some would say, bad money?
Yeah, I mean, you could say that. I guess there is the question: are they, like you said, throwing good money after bad? On the other hand, they are very committed to this. They own, they've put a lot of money into WeWork. It's a big part of the Vision Fund, and I think there's an argument to be made. Notwithstanding David's concern that there is a possibility if they run out of money, the whole thing falls apart. On the other hand, there is an opportunity here. Giving these kind of more flexible leases to technology companies, creating these open desk environments, which people really seem to like. I mean, you talk to people who are in WeWorks, they like it. So there's a real business there. The question is, has WeWork, in its effort to grow really quickly and come up with all these weird financial engineering things, bitten off more than it can chew?
David, I give you the last word on WeWork. Why would SoftBank want control of this company? To control the destiny?
Yeah, I mean, they're the ones that have got the most at risk, so they would probably prefer to be making the decisions. I can understand that. And I do agree with Max. A business is definitely viable here, but let's remember, their competitor that has more, the main competitor, which has more spaces than they do and has been around a long time, public company, it has a valuation less than $5 billion.
Max, I want to switch on over to Netflix. That's another big tech earnings that we were taking a look at this week. Low expectations, earnings were better than expected. And then on Friday, people got nervous again about competition. Where does Netflix fit in amidst the streaming wars?
Well, I mean, the issue with Netflix is, it's gotten a huge user base over the last few years, but they've been spending just enormous sums of money acquiring content. There's this kind of concern. It's kind of a two-part concern. One is, has there been sort of an overinvestment, maybe a content bubble? Are people overpaying for these original series? And then do you have the risk of kind of viewer fatigue, where we're about to see Disney, launch a service. Apple is launching a thing. These are big, marketing machines that will sort of inevitably take customers and mindshare away from Netflix, and then you start asking, well, did we pay too much for some random show season 3 or whatever, where there's this kind of very spendy culture there, and maybe they went a little too far.
David, as you take a look at the landscape, is it a zero-sum game? Can Netflix survive with that competition that Max just talked about, like a Disney, like an Apple TV, all coming and coming fast?
I don't think it's at all zero-sum because people watch so much video, for one thing. I also think, for those of us like myself, a baby boomer, Disney seems like such a great brand, but I think actually in the general economy, Netflix is probably a better brand than Disney. And everybody knows they make terrific content. They're going to be out there succeeding. They probably will have a lot less pricing flexibility as the competition increases, so their growth could be hurt. But look, their main growth is happening outside the developed countries right now, just like so many of the tech companies and the internet companies, and that is still a big opportunity.
Max, I pivot now on over to Libra, which, as we know, it's Facebook's cryptocurrency. Earlier this week, we saw 7 big members of that founding association pull out, but they got the deal signed on the dotted line with 21 members. What are the biggest hurdles that remain for Libra as you look out forward?
So many hurdles. I mean, this thing is pretty much, they did, form this association. So I guess in theory now it's separate from Facebook. It's able to, design this cryptocurrency cryptocurrency, you know, and work with regulators. I mean, you know, there are regulators, though, have serious concerns about this because there is the risk, and I think it's a really extremely modest risk that Libra could, you know, supplant, say, the U.S. dollar or the euro, basically allow the Libra Association, which in effect is Facebook, to you know, control a huge part of the economy, and that's going to be scary for all sorts of powerful people.
David, your thoughts on Zuckerberg's testimony next Wednesday, which could be centered around Libra? Any thoughts on what could or could not go right?
It will not go well. I think he's making a gigantic mistake thinking that he can somehow go to the House Financial Services Committee and convince them that Libra is a good idea. They do not think that. They are not going to think that after his testimony. He's boxed himself in by saying he won't launch it without the regulatory approval both in the U.S. and Europe, which some people think means that he will possibly launch it in Vietnam or, you know, Colombia or some other as a test case, and then see if it works and eventually bring it here after he irons out the kinks. But honestly, I have often thought in recent weeks that Libra was completely dead, and I don't think that's out of the question. I don't really think it has a strong argument on its behalf, and I can tell you, Congress people do not, and they do not like it.
And David, just the final word here. Why is Facebook going into side projects like Libra instead of sticking to their core business?
Well, you know, somebody made an interesting point to me today. You know, Facebook's one of their core beliefs is that virtual reality is one of the main things they're going to be doing in the future. It's going to be global interaction, and if they want to do commerce in global systems, they need currencies that somebody in the U.S. could pay to somebody in Nigeria or vice versa. That's not a bad thing. We should have such currencies. I just don't think the world wants them to provide it.
Right. Bloomberg's Max Chapkin and a very smart, insightful Techonomy's David Kirkpatrick. Thank you both for joining me. And coming up, he co-founded Facebook. Now he's trying to rein in his co-creation. We hear from Chris Hughes next. This is Bloomberg. The co-founder of Facebook is once again weighing in on the regulation of big tech. And this time he is bringing a former lawmaker with him. Chris Hughes, an Open Society's U.S. executive director and former congressman of Virginia, Tom Perriello, are spearheading a $10 million fund focused on anti-monopoly efforts. They spoke with Bloomberg's Alex Steele and David Weston on Friday.
What we're seeing in the country is rare bipartisan consensus on the left and the right that corporations have gotten too large, too big, and that concentration is affecting everyday Americans, specifically because those corporations have written the rules of how it works. So what we're trying to do with this fund is move $10 million over the course of the next year and a half into research, organizing, advocacy, and storytellers who elevate this conversation. So anti-monopoly in particular is a broad term. It encompasses antitrust work, but it also encompasses regulation. And so a good example is the problems with big tech right now. Everybody's talking about it. Of course, I'm on the record for thinking that Facebook should be broken up and separated. I also don't think that's enough. We need regulation that guarantees interoperability, data portability, basic privacy and security, and all of that is about reining in the power of the big corporations. So that's why we call it anti-monopoly, because the problem is really that big.
So Tom, let's talk about what exactly the problem is. Is it an economic problem or is it a social democratic problem? Because those are two different issues and they could have two different solutions. The antitrust laws, at least within recent memory, have been really directed at economic issues, not at social issues.
Well, first of all, on the economic side, as you know, the antitrust really was cut in half because initially it was both about trying to ensure competition and protect consumers. And from the 80s forward, it focused on the consumer part, but not the competition part. And that's been at great expense of small businesses across the country and really helped spur a lot of the geographical consolidation as well into fewer and fewer cities where the jobs are concentrated. So you do see this remembering of a great bipartisan American tradition of competition.
Well,
there is a sovereignty and freedom.
Going back to Brandeis or something like that, but part of the reason that shift was made, it wasn't just University of Chicago being so influential. It was also because it gave some sort of a mooring to the judge's decisions. Because if it was economics, you could have numbers, you could look at them. If you get into is it too big or too small, then it's just up to the judge and how they feel on a particular day.
Well, I don't think the issue of competition is a non-economic issue, and I think that question of allowing sort of the Walmarts to emerge and now the Amazons to crush the Walmarts has had some positive effects for the consumer in the short term, but has had real economic considerations in terms of consolidation, not just on an individual but a geographic level. But I think you're also seeing this bipartisan support for attorneys generals and others because there's something about this question of people's sovereignty or freedom to determine their future.
Chris, one question is what's the most effective form of regulation if there's to be regulation? You talked about breaking up Facebook. I talked to Tom Steyer earlier this week, and he thinks there should be regulation, but he thinks actually that would not work because they're natural monopolies. You have to regulate them like a utility. This is what he said, in part. If you believe that breaking them up, he's talking about Facebook and Google, would result in all the same people going back to the one place where they started, then it requires government regulation the way a public electric utility does. Does he have a point?
I don't think that's quite right. I think that because I lived through the founding of Facebook in the first decade, we saw robust competition between Facebook, MySpace, Twitter, LiveJournal, Tumblr. I mean, the list goes on. And so this is not like the electrical grid or the pipes where there's only so much space, and once you invest in the infrastructure, you've got to have a natural monopoly that needs to be regulated. This is much more akin to what we've seen across other industries in the past. Now, to your question that you were getting at before about the harms, I think that in general, antitrust law in particular has been completely narrowed into this view on consumers and largely prices. And that's been a big barrier to talking about Facebook or some of these other companies, when the long arc of antitrust law is about all kinds of harms. Right now, what are the harms that big tech and other big companies in agriculture, pharmaceuticals are doing to the economy? First, there are price concerns, absolutely. Second, rates of entrepreneurship and small business starts in this country are near an all-time low. Third, productivity rates are much lower than they should be. They've effectively stalled. And then maybe most importantly is the question of power and political power. We live in a moment right now when large corporations are setting the agenda in Washington and completely erasing the voices of everyday people, and Americans are tired of it.
Have you talked to Mark Zuckerberg about this?
I haven't talked to him since the piece in the spring.
How would your view be different if you had a seat still on Facebook in the C-suite and you were running a big company? Like, what would you think?
I think I'd be saying many of the same things. You know, after I wrote the piece in the spring that called for breakup, a lot of people asked me, well, what do you think Mark Zuckerberg should do? You know, what's the next step? And I said to them, and I would say today, the problem isn't what Mark Zuckerberg should do. We've been so accustomed to thinking about how corporations can solve our problems. Mm-hmm. The responsibility is on government. It's on the Department of Justice, the FTC, and the state's attorney generals. And just since the piece has come out, we now have virtually every branch of government that could be bringing oversight, the House, DOJ, FTC, and the state attorney generals stepping up to the plate in a rare bipartisan consensus to take action and to say enough is enough.
Tom, to what extent does it have to be a structural remedy, like breaking up, as opposed to a behavioral one? I mean, we had Macon Delrahim, the head of the antitrust division, come out and say, for example, in the Microsoft instance, when the Justice Department brought a lawsuit, the ultimate result was behavioral, and he said that did encourage some of the entrepreneurship and the growing of new businesses under that. Can behavioral remedies, in part, solve this problem?
We can, and I think this anti-monopoly fund is looking at that full range of solutions. We're looking at how policymakers, there's some litigation elements, there's some breakup elements, consumer power. Right now, I think you're seeing some of the loudest voices of concern coming from small business owners who are seeing that a Google or an Amazon can have an enormous effect on their business and even squash it based on where they appear in an algorithm. And they don't feel like that's fair. They can have built that business for years and years in terms of their relationships with the customers. And those are the kind of small business owners that call up their representatives, Republican or Democrat, and say, something here just isn't right in this marketplace. People want fairness. They want fairness of competition. They want transparency to know what the rules are. And certainly behavior can be part of that.
And this also goes to sort of the broader issue of privacy, really. Mark Zuckerberg yesterday gave a speech talking about free speech, standing behind that, and why we needed to protect it.
I understand the concerns that people have about how tech platforms have centralized power. But I actually believe that the much bigger story is how much these platforms have decentralized power by putting it directly into people's hands. While I certainly worry about an erosion of truth,
I don't think most people want to live in a world where you can only post things that tech companies judge to be 100% true.
Chris, what's your reaction to that? In that, if you're big and you have the power and you can have free speech, that's a huge move forward. It's a huge democratizer.
With power comes responsibility. And the speech that Mark gave yesterday set up a false dichotomy. It's either Facebook's policy today or it's China's authoritarian regime. And I'm sorry, but there's a lot in the middle, and we can do better. So there's been a lot of talk about freedom of speech on Facebook and other platforms, and no one is saying that you shouldn't be able to share opinion, however off the wall it might be, yourself. The question is whether or not Facebook or any other platform on the internet should amplify that opinion and give you an audience of hundreds, thousands, or in many cases, tens of thousands. And in my view, when a politician says something that's been fact-checked as a lie, or when folks peddle false information about critical healthcare things like vaccinations, it is the platform's responsibility not to amplify those messages. And we have precedents for other platforms doing a better job. Pinterest, for instance, allows users to express their opinions. It's not the largest platform in the world, but they are pioneering the way to express their opinions, and yet they don't use their algorithmic tools or display it in search results in order to make sure that the false information doesn't travel across the platform. So we have the idea that it's got to be one or the other is a false choice, and there's a responsibility on these platforms to step up and do a better job.
There was a great Orwellian moment from Facebook a few months ago in this controversy where they said we are not a media company and shouldn't therefore be held accountable to that. And they want to be essentially a monopoly on all media information in the world while not being held to the standards of a media company that we would hold to this network or any other. And so I think the problem when you get that kind of monopoly consolidation, particularly when it's across different sectors of the economy, is what should the rules be, whether it's behavioral and ethical codes or whether it's legal codes. And this is really fairly new territory, but again, something that in earlier eras we saw, and great leaders stepped up and broke up some of those trusts, and that helped produce some of the great economic benefits of the 20th century.
That was Chris Hughes, Facebook co-founder, and Tom Perriello of Open Society. And it's still ahead, the chase for Hollywood's best binge-worthy series, it continues, this time with South Park. How the cartoon could be the next $500 million bet for streaming services next. This is Bloomberg. Count the chief executive officer of the biggest U.S. bank among doubters of Facebook's effort to create a cryptocurrency. Jamie Dimon had this to say on Friday in Washington.
It was a neat idea that will never happen. All right. And I have nothing else to say about it. And we already have stable coins, so they're not the first to do that.
That was J.P. Morgan CEO Jamie Dimon. Now, South Park is the latest beneficiary of Hollywood's rerun mania. The show's creators and media giant Viacom expect to share between $450 to $500 million by selling the streaming rights to the animated comedy. To discuss, I'm joined by Bloomberg Technology's Lucas Shaw. Lucas, $500 million, are you crazy?
We have never seen a market for reruns that I can remember like this. I mean, just 4 years ago, 2015, Hulu paid between $150 million and $200 million for the rights to show South Park for 5 years. So now in 2019, that price has more than doubled to almost $500 million. The simple explanation is that back then you just had Hulu, Amazon, and Netflix fighting for the rights. A lot of the reruns would air on basic cable, and now you have so many streaming services jockeying for position. You have HBO Max from AT&T, you have Peacock from Comcast, you have Disney Plus and Apple TV Plus from their own companies. You add that to the three big streamers that we just talked about, and there's just a lot of buyers and only a small pool of shows that are seen as really mattering. Friends, The Office, Seinfeld, these are shows that get $400 million, $500 million. Lots of other shows are not going to get that same level of commitment, and South Park is really a unique title.
And the strategy is to build up your library to compete with Netflix, right?
Yeah, I think the idea is you want something that a lot of people are going to come and watch, either the reason that they sign up in the first place, although that's usually originals, or another show that's going to keep them watching in between. And that's where a lot of the reruns come in. If you have a show like Friends or The West Wing, or in the case of South Park is in its 23rd season. There are more than 300 episodes. If you include that in your HBO Max, maybe you bring them in with the latest HBO hit, but in between watching that and something else, instead of leaving to go to Netflix, they could just stay there and watch South Park for hours on end.
What is the biggest payoff for these streaming companies? Investing in original content or paying $500 million for a rerun?
They say originals, and that's why you've seen Netflix in its strategy shift from doing bulk deals for lots of old library to then funneling that into new product. Because especially if you want to sign up customers, you need originals to do that. Reruns are not super useful for bringing in new people. You don't walk down the street and say, hey, you should really sign up for this service. They have Friends. Friends is available in a lot of places, not just streaming. But reruns are useful, again, for those kind of in-between moments, because what Netflix has said, for example, is that most of its users, they'll kind of alternate between a show and a movie, and they're trying to essentially replace cable with a couple of streaming services. And cable has both new shows and reruns, TV shows and movies. And so if you want to offer a full experience, you're going to mix kind of new big hits with the old ones.
So Lucas, remind us quickly, who are the big streaming companies that are all vying for these types of shows?
With South Park, it sounds like the biggest bidders are probably HBO Max, Peacock, which is Comcast, Hulu, which currently has the rights, maybe a couple of others, maybe an Amazon. I'm told that Netflix is not bidding. Netflix is obviously the biggest streaming service of them all, and did pay for Seinfeld, is losing both Friends and The Office. But all these companies are having to pick and choose because with the prices so high, you can't have everything.
Thank you to Lucas Shaw in Los Angeles. And that does it for this edition of Bloomberg Technology. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at TikTok, on Twitter. This is Bloomberg.